If you own Palantir stock, I need you to stop what you're doing and listen, because what I'm about to tell you could save you from a massive mistake. This is your warning. If you own Palantir stock, read this first. The stock just dropped over 20% from its peak. The CEO just sold $96 million in shares, and one of the most famous investors in the world just bet against it. But here's what nobody is talking about. This might be exactly what long-term winners have been waiting for, or it could be the beginning of something much worse. I'm going to break this down into 5 critical sections with a couple of bonus sections at the end. First, the uncomfortable truth about who should actually own this stock. Second, the real numbers behind the business. Third, the insider selling panic and what it really means. Fourth, the competitive advantage nobody understands. And fifth, the valuation nightmare and what you need to do next. And sections 6 and 7 on some deeper insights. Now you got the roadmap. Let's dive in. Section 1, the uncomfortable truth. Everyone says they're a long-term investor until their stock drops 30%. Then suddenly they're a genius who sold at the top. They're on message boards asking strangers if they should panic sell. They're blaming everyone but themselves. Here's the truth. If watching your account drop makes you lose sleep, you have no business holding this stock. Palantir isn't comfortable, it's not steady, it's not safe. This is a stock that will test you, it will shake you, it will make you question everything. The stock was up 120% this year, then it fell 20% in a few weeks. That's not unusual for Palantir, that's normal. Most investors can't handle that, not because the stock is broken, because they are. They want a stock that goes up in a straight line. They want guarantees. They want to feel smart without doing the work. But here's what separates real investors from pretenders. Real investors understand something critical. Volatility isn't risk. Permanent loss is risk. And right now, everyone is confusing the two. So before we go any further, ask yourself this question. Can you handle a stock that might drop another 20% tomorrow? Can you handle watching it swing wildly while you hold? If the answer is no, close this video, go find a stable dividend stock, put your money in an index fund, because what I'm about to show you requires a spine. Section 2. The numbers that matter. Let's talk about what's actually happening with the business, because this is where most people get it completely wrong. Palantir just reported their third quarter results, and they were incredible. Revenue grew 63%. That's not a typo, 63% in 1 year. But here's where it gets crazy. Their commercial business in the United States grew 121%. Let me put that in perspective. Imagine you own a lemonade stand that made $100 last year. This year you made $221. You more than doubled your business in 12 months. That's what Palantir just did. With a billion-dollar company, their profit margins, over 30%. Their free cash flow margin, 46%. These aren't startup numbers. These are elite numbers. These are the kind of numbers that separate great companies from average ones. But the stock still dropped. Why? Because at these prices, the market isn't paying for great. The market is paying for perfect. Palantir stock trades at over 380 times earnings. That means you're paying $380 for every $1 the company earns. For comparison, most technology stocks trade around 20 to 40 times earnings. This is where people lose their minds. They look at that number and say it's insane, it's a bubble, it can't be justified. And you know what? They might be right, but they might also be completely wrong. Because here's what history teaches us. Every legendary stock looked expensive before it proved itself. Go back and look at the biggest winners. Microsoft, Apple, Google, Amazon. They all went through this exact phase. People called them overvalued, overhyped, too expensive. And the people who sold during those moments, they missed out on fortunes. The real question isn't whether Palantir is expensive today. The question is whether it can earn its valuation tomorrow. Section 3. The insider selling panic. Now let's address the elephant in the room. The CEO just sold $96 million in stock. Other executives sold too, over $200 million total, and the internet lost its mind. Headlines everywhere. The CEO is cashing out, insiders are running, it's over. Let me explain why this reaction is exactly what separates amateurs from professionals. First, understand how CEO pay works. Alex Karp doesn't get a massive salary like you and I do. His real compensation comes from stock, lots and lots of stock. So when he sells, he's not abandoning ship. He's converting some of his pay into actual money, so he can buy things like houses and food. Second, a look at the timing. The stock is up 120% this year. It recently hit all-time highs over $200 per share. If you were sitting on stock worth hundreds of millions of dollars, wouldn't you take some profit near the top? That's not panic. That's smart. Third, and this is critical, Alex Karp still owns millions of shares. He's not leaving. He's not selling everything. He's diversifying. After selling $96 million worth, he still has over $1 billion in Palantir stock. Does that sound like someone who thinks the company is doomed? But here's what really matters. These sales were planned months ago through something called a 10b5-1 plan. That's a legal structure where executives schedule sales in advance so they can't be accused of using inside information. This wasn't a panic move. This was planned, legal, normal. But retail investors don't understand that. They see big numbers and freak out. And that's exactly how they lose money. They buy when everyone is excited. They sell when they see scary headlines. They let emotions drive decisions. Winners do the opposite. Section 4. The moat. Nobody understands. 7-930. Let me tell you something that most people completely miss about Palantir. 2 years ago, I had spinal fusion surgery. Once that hardware went in, it became part of my spine, part of my body. Ripping it out would destroy everything. That's what Palantir is to its customers, not just software, infrastructure. Once Palantir gets deployed inside a company or government agency, it doesn't just help them work faster, it completely rewires how they operate. Think about it like this. Imagine you run a massive hospital system. You have patient data, scheduling, inventory, billing, everything scattered across dozens of systems. Palantir comes in and connects everything. Suddenly you can see patterns. You can predict problems. You can make decisions in real time. Now imagine trying to rip that out and replace it with something else. You'd have to retrain thousands of employees, rebuild all your processes, risk breaking critical systems. Nobody wants to do that. And that's the moat. That's the competitive advantage that doesn't show up in the numbers. This isn't like switching from one messaging app to another. This is structural. Once you're in, you stay in. And here's what makes it even more powerful. The longer customers use Palantir, the more valuable it becomes. Because as they add more data, the system gets smarter, the insights get better, the dependency gets stronger. This is why Palantir's contracts last for years. This is why customers expand their usage over time. This is why government agencies that started using it a decade ago are still customers today. The switching cost isn't just financial, it's operational, strategic, cultural. If you're the decision maker at a Fortune 500 company or a defense agency, who are you going to replace Palantir with? Exactly. There is no replacement. That's a real moat. And it's growing stronger every day. Section 5. The Valuation Nightmare. 9:30 to 11:45. Now let's talk about the part that keeps everyone up at night. The valuation. Palantir trades at about 380 times earnings. Its price to sales ratio is over 100. On paper, it looks absolutely insane. And if you just look at those numbers, it is. But here's what you need to understand. Every magnificent stock went through this exact phase. When Google was young, people said it was overvalued. When Amazon was scaling, people said it was too expensive. When Netflix was growing, people said it couldn't justify its price. They were all expensive until they weren't. Because the valuation question isn't about today, it's about tomorrow. If Palantir can maintain 40% growth for the next 5 years, the valuation starts to make sense. If they can expand their margins while scaling, the multiple compresses naturally. If they can dominate their market the way they're positioned to, today's price becomes tomorrow's bargain. That's a big if, a massive if, but that's also how fortunes get made. Not by buying stocks that are obviously cheap, but by buying companies that can grow into their valuations. Now here's the risk nobody wants to talk about. Palantir is priced for perfection, not good performance, perfect performance. If they miss earnings by even a little, the stock could drop 30%. If growth slows down, it could drop even more. And with a beta of 2.2, when the market panics, Palantir doesn't just fall. It crashes. This thing doesn't pull back gently. It drops like a freight train. So you need to be honest with yourself. Can you handle that? Because if you bought at 200 and it drops to 140, are you going to panic sell? Or are you going to understand that this is just part of the journey? Every magnificent stock had moments where it dropped 40%, 50%, sometimes more. And the people who held through those drops made life-changing money. The people who sold, they're still talking about the one that got away. Section 6. The Michael Burry situation. 11:45:13 so. Let's address the famous investor who just bet against Palantir. Michael Burry, the guy from The Big Short, the one who predicted the 2008 housing crisis. He just revealed a massive short position against Palantir, betting it will fall, and the internet exploded. But here's what most people don't understand. Burry has been wrong plenty of times. Being right once doesn't make you right forever. He's also shorting NVIDIA. He thinks the whole smart computer revolution is a bubble driven by fake accounting and hardware that will become obsolete. Maybe he's right, maybe he's not. But here's what I know. CEOs like Alex Karp are calling Burry's move market manipulation. They're saying it's designed to scare retail investors into selling so hedge funds can profit. I don't know if that's true, but I do know this. Legendary investors disagree all the time. Warren Buffett avoided tech stocks for decades while others made billions. Just because someone famous bets against something doesn't make them right. You have to decide for yourself. Is Burry seeing something everyone else is missing? Or is he early, wrong, and about to lose a fortune? History will tell us. But you can't make decisions based on what one investor thinks. You have to look at the business, the fundamentals, the trajectory, and decide if you believe in where this is going. Section 7. The real question, 13 to 1430. So here's what it comes down to. Palantir is growing faster than almost any company its size. It's profitable. It has a moat. It's expanding into massive markets, but it's also expensive, volatile, and priced for perfection. The bull case is simple. If Palantir keeps executing, if they maintain this growth, if they become the infrastructure layer for decision-making in governments and enterprises worldwide, then this stock could be worth multiples of today's price. The bear case is equally simple. If growth slows, if a recession hits, if competition emerges, this stock could lose half its value overnight. Both scenarios are possible. So what do? First, understand what you own. Don't hold Palantir because someone on the internet said to. Hold it because you believe in the thesis. Second, size your position appropriately. This shouldn't be 50% of your portfolio. This is a high-risk, high-reward play. Third, have a plan. Know what you'll do if it drops 30%. Know what you'll do if it doubles. And fourth, stop checking the price every day. If you believe in the long-term story, short-term moves don't matter. Every magnificent stock had doubters. Every legendary investment looked risky at the time. The question isn't whether Palantir is expensive. The question is whether you have the conviction to hold through the chaos. Here are my final thoughts. Palantir isn't for everyone. It's volatile, it's expensive, it's controversial. But it's also one of the most interesting companies in the world right now, growing explosively, dominating its niche, building infrastructure that customers can't live without. The stock dropped 20%. Insiders sold. A famous investor bet against it. And you know what? That might create the opportunity of a lifetime, or it might be the beginning of a painful correction. Only time will tell. But if you own this stock, you need to know what you're holding. You need to understand the risks, and you need to have the stomach for what comes next, because this isn't going to be a smooth ride, but nothing worth having ever is. If you found this helpful, hit that subscribe button, drop a comment, and tell me if you're buying this dip or staying away. Because one thing is certain, Palantir is going to make some people very rich, and it's going to burn others who weren't ready. This isn't Financial Advisor. Do your own research. Make sure you know which side you're on. If you come this far, watch the video coming up on your screen now. Thanks for watching. I'll see you in the next one.